coming in from Market Watch, billionaire investor, enjoy the bull market while it lasts. Whenever you bought into the market when it was selling at the present multiple of say 22 times or higher, you've never really made any serious money 1 year, 3 years, 5 years out. I think that's what we're looking at. And that's the interesting thing. That's what a lot of people are saying. Very smart and very successful investors over a long, long period of time are warning that buying into the market right now at these multiples means that over the next decade, your returns are going to be very, very weak at best. Yeah, that's the concern. Anyway, let's read on. That's Leon Cooperman, the billionaire behind the Amiga family office, talking to CNBC on Wednesday about how the stock market will likely struggle to deliver the goods for investors who are banking on the continuation of the bull run. The near-term outlook is probably okay, Cooperman told Squarebox hosts. Long-term, I think we're borrowing from the future. And that's it. That's the key. That's the interesting thing right there, is what central banks have done by just artificially lowering interest rates has pushed investors out the risk curve to try to get a return on their funds. And it's also brought forward that demand, that future demand. So, for example, in Australia, real estate, we go into the worst recession that we've had since the Great Depression in the 1930s. And what does the government do? They allow you to pull money out of super. They give a $25,000 home builders boost grant, as well as state government grants, and so they literally pulled all the demand for property for especially first home buyers. I would say not just in 2021, but over the next few years, those people that were probably going to buy in a few years' time, that was pulled forward to now. The question is, well, two things. The question is, what's the demand going to be like this year and next year if we brought so much of that demand forward already? And the second thing is, what happens when the grants all end? Well, we know that everyone's pulled their money out of super. That's ended. No more of that. As of January 1 this year, the home builder boost went from 25,000 to 15,000. And at the end of March, that ends completely. So the question is, have we brought forward all this demand? Also, it's been for new dwellings, which means more supply onto the market, more homes. How's this all going to play out into the future? That's my question. Anyway, let's keep reading. He put the blame on the Federal Reserve's monetary policy as well as the government's aggressive fiscal stimulus for creating an environment fraught with risk going forward. There's a meaningful chunk of the market today that's in euphoria. You see 50% price moves, Cooperman explained. I do have long-term concerns because I think the policies we're running are unsustainable. I agree. He added that the incoming administration could also put pressure on the top-heavy market. It's a less pro-business, less friendly business environment, he said. Still, Cooperman said he put his values ahead of his economic interests and voted for Joe Biden. That's interesting because from what I know of Leon Cooperman is he pretty much supports Republicans and that side of politics. So let's have a look at this little interview and see what he's got to say.
The economy before COVID, which was running at a fully employed level, was running $1 trillion deficit. You're not supposed to have $1 trillion deficit when you have a fully employed economy. So, we then got COVID, and now we're spending into oblivion. We have a very difficult situation out there because I think in the near term, it's hard to fight the market. You have extraordinarily stimulative fiscal and monetary policies, all of which I think is pulling demand forward. But somewhere along the way, we're going to have to pay for the party when the party is over. We talk about the poor performance of the economy. I'm not an economist, but let me just share with you numbers that strike me as interesting. If you talk to most economists, they would say trend real growth in the economy is probably around 2%. Trend real growth is derived by looking at the productivity growth of the economy, which is about 1.5%, and labor force growth, which is about 0.5%. So trend real growth of the economy is 2%. If you talk to most economists today, they have real growth fourth quarter this year versus fourth quarter last year of 6%. So we're growing at 3 times trend, yet the Fed feels necessary to keep interest rates at 0. Okay, and what the Fed is doing is they're pushing everybody out in the risk curve. The person previously who was very risk averse and bought T-bills concluded, I can't survive on 0, so I'm going to take duration risk and I'm going to buy T-bonds. The T-bond buyer says, well, 1% doesn't work for me. I'm going to buy industrial bonds. The industrial buying person concludes, I can't get by on 2 or 3%, so I'm going to buy high yield. The high yield buyer says, I can't get by on 4 or 5%, so I'm going to buy structured credit. The structured, which is more opaque. The structured credit person says, well, given how hot the market is, I'm going to put 25% of my credit fund in equities, and the equity guy is now moving into Bitcoin. So everybody's moving out in the risk curve, and they're being forced in that direction by very stimulative fiscal monetary policies. And somewhere along the way, we're going to have to pay this price. And so, you know, I have this dual outlook. I think the near-term outlook is probably okay. Long-term, I think that we have borrowed from the future. And whenever you bought into the market when it was selling at the present multiple of, say, 22 times or higher, you've never really made any serious money 1 year, 3 year, 5 years out. I think that's what we're looking at. I think we have borrowed from the future. And we should understand, as much as I voted for Biden, I voted with my values, not my pocketbook. He's talking about higher corporate tax rates, higher individual tax rate, higher capital gains tax rates. You know, we have more progressives in the government, more protectionism. You know, they're attacking these high-tech companies that are probably the main source of growth in the economy and have done a fabulous job in dealing with the virus. I mean, it's a less pro-business, less friendly business environment at the same time where the Fed and the Congress is just pouring more fuel on the fire. So it's a very interesting thing. You know, many times in your program, I quote the great John Templeton, who's observed bull markets are born in pessimism, grow in skepticism, mature in optimism, and die in euphoria. There's a meaningful chunk of the market today that's in euphoria. You see 50% price move. You see a SPAC a minute coming. That's stuff that's ringing the bell. Okay. On the other hand, I find a lot of things that are attractive. So I'm finding things to do, investments to be made, but I'm very skeptical about the longer term outlook.
And coming in from Bloomberg, Singer says long-term bonds are a senseless speculative trade. And I agree. We've got the biggest bond bubble. The biggest bubble in the world is actually in bonds. It's in bonds. It's not in Bitcoin or Bitcoin, as some people say, or the stock market. The bond market is the biggest bubble in the world at the moment. Singer says that the market isn't ready for rapid inflation pickup. Long-term bonds no longer hedge for equity portfolio. I couldn't agree more. Billionaire Paul Singer has a warning for his fellow investors. 1970s style inflation can happen again, and almost nobody is ready for it. Well, some of us are. The hedge fund manager, a frequent critic of US monetary policy, said in an interview on Grant Williams' podcast that the combination of trillions and trillions of dollars, the relief spending, wage pressures, and rock bottom interest rates has the potential to shock markets. The interview was taped last week and published Friday. Now, if you aren't listening to Grant Williams' podcast, you better jump on to iTunes or whatever platform that you use and start listening to him. He has the best of the best people in the investment world on his podcast. There's a really good chance of a tremendous surprise, and a surprise in the relatively near future, said Singer, speaking on the likelihood of consumer price spiking higher. I think we've already seen that. Bonds could have a very significant and abrupt and intense price readjustment. Bond market indicators of future inflation have risen sharply over recent months. Yeah, there we go. With 10-year break-even rates derived from the gap between yields on inflation-linked and ordinary treasuries, climbing above 2% to the highest since 2018. That's up from a low of 0.47% last year at the onset of the expansionary fiscal policy is helping to drive the change in outlook. even as the Federal Reserve, which holds a meeting next week, has struggled to gin up much inflation the past decade with its own tools. Well, yes, but in the last decade, I've said in previous videos, what did they do? They just did simply quantitative easing, and that's basically creating bank reserves, so recapitalizing the banks. So they create bank reserves, and those bank reserves are held at the Fed. They can't be legal tender directly out into the real economy. The banks then have to use that as collateral to create new loans into the marketplace. But what we've seen this time is basically the Fed and the government working hand in hand, with the government doing massive fiscal policy, with the Federal Reserve picking up that. So the I guess new currency units at the or the bank reserves at the Federal Reserve and all central banks around the world have been getting out into deposit accounts and into people's back pockets through the government's fiscal meaning, because the banks really around the world haven't been lending. In Australia, they have. Lending to especially real estate has been very, very strong, but obviously there's been other incentives and whatnot pushing that. So that's the reason why there hasn't been much CPI increases. There has been inflation, by the way. You get like 2 to 3% inflation each year over a 20-year period. That's a 50% reduction in purchasing power. So if you just hold savings over that 20-year time, you're going to have 50% less purchasing power. So small little bits of CPI inflation can be very damaging for savers and for workers. It's been promising not to apply the brakes anytime soon and urging politicians to hit the accelerator with more pandemic stimulus. President Joe Biden's new administration is poised to oblige, asking Congress for another $1.9 trillion. Singer, whose Elliott Management Corp has one of the best track records in the hedge fund industry, said that holding longer-term bonds is senseless at current yields. Hallelujah, someone's speaking some sense. No institution can meet their goals by owning those bonds. There's no longer a hedge against equity portfolios, he said. When you buy something with no yield, where you can only make money and the yield goes from 0 to -5 or -10, you're engaged in speculation. You're not engaged in investing. Hallelujah! I've been banging on about this for like 10 years. That bonds, once upon a time, your standard portfolio of a 60-40, split between stocks and bonds. You have bonds, which is that conservative, protect your capital while earning maybe 5-6% yield on it. So, very, very safe, secure, blah, blah, blah. People haven't been investing in bonds with that strategy, which is what bonds have always been about. People have bought bonds because they think interest rates are going lower. So the yield goes from 0 to -5 or -10, and therefore the price of the bond goes up. So people are investing in bonds, basically front-running the Fed to simply get capital growth or capital gain on the bond. So the bond market, as I said, is the biggest bubble I have ever seen in my investing career. Along with inflation expectations bubbling higher, long-term government bond yields have surged, with the 10-year Treasury yield hovering near 1.09%, up 18 basis points just this year. Actually, it went a bit higher than that recently. The 30-year yield is up about 20 basis points to 1.85%. I'm not talking about to 15%, but a price readjustment to yields of 3 or 4 for the 30-year or the 10-year in America would cause quite a ruckus, he said. Absolutely. And here's the bind that central banks and governments have got themselves into. They've backed themselves into a corner with just record amounts of government debt, corporate debt, household debt. If yields were to rise to 3 or 4%, I don't see how households and corporates, can afford to make those repayments. That's going to be very problematic. And in some cases, and some people say that now even governments themselves won't be able to pay that problem. And what will happen is, well, central banks will have to print more, create more, just to continue to pay the bills. So basically, it's like a Ponzi scheme, and it does not end well. Or the other option is, do the central banks come in with yield curve control, try to cap interest rates, allow the CPI, inflation, to run much, much higher, so you've got deep negative real rates, and do that. The problem is when you let that inflation genie out of the bag, it's hard to get back in, or out of the bottle. It's hard to get back in. This is going to be very, very interesting over the coming months and years to see how this all plays out. There is going to be some kind of reset of some sort, and I don't want to get into this video talking about the World Economic Forum's Great Reset plans and the UN and the IMF and all those people pushing for a great reset. I don't want to get into that video, in this video, but there is going to be some kind of reset, because we're almost at the point where there's no way out of this mess. So yeah, that's this one. Now I want to show you. This is what I wanted to show you. So this is the Fed balance sheet, which is about to hit 42% of GDP. How does the Fed and central banks around the world unwind their balance sheet without destroying the market, collapsing the market, all markets, stock market, bond market, you name it, property market, the whole global economy? We are on a nice edge economically, and people are so unaware of this. We can see that just the difference of the Fed's balance sheet. So this is a GFC. So when apparently the whole global economy was about to collapse, and the central bank went into this, or World War II, while funding a war, the Fed's balance sheet only rose there. Have a look at what's happened just in the last 12 months. Absolutely vertical, parabolic. And the question is, how do these central banks unwind this? How do they unwind this? I don't think they are able to, because if they try, they collapse the markets. Everything's so overvalued. Everything is just relying and held up by Fugazi. It's a woozy, it's a wazi. I think central banks and governments are going to keep the foot on the floor, and they won't be able to stop. They're just going to keep the pedal to the metal, and they've been told this: spend as much as you can, and then spend a little bit more. So, at an economic forum last week, the managing director of the IMF told governments, in terms of policies for right now, very unusual for the IMF, starting in March, I would go out and I would say, please spend as much as you can, and then spend a little bit more. She added that she continues advocating this policy. Governments across the world are in massive debt, and essentially all of them continue to finance their debts by printing currency. Meanwhile, economies have shrank over the past year due to COVID, cough, restrictions on travel and business. So more debt, a smaller economy, and more paper currency than ever, with nothing backing it. What could possibly go wrong? And this is where I think they're at. This is what they're going to do. And think about the consequences with a smaller economy, less production, less goods and services, but a lot more paper currency, chasing less goods and services. What does that equal? Now, for those of you who have been following my videos and most of my presentations throughout 2020, know that my thesis is that we are going to have significant inflation, that central banks and governments have backed themselves into a corner. They've shown that they will not allow deflation. They will not allow the free market to work. that they will turn on the printing taps, they will spend, and they'll do whatever they can to keep markets up and to just throw new currency units into the economy. But the economy has been damaged. It's been wounded severely. And so that's my thesis. Okay, and that's my base case, and that's where I'm going with. However, there is a caveat, and that is if governments do decide, enough is enough, we're going to step aside and allow the free market to work, and we start seeing bankruptcies and defaults right across the board, then that's going to be a destruction of currency, which is deflation. Now, governments and central banks haven't indicated one iota in their actions that is going to happen. However, that is a chance. And so when I say I'm investing for that inflationary outcome in the months and years ahead, that is with a caveat that if governments decide enough is enough and they back off and allow the free market to work, I will turn on a dime. And in this article, Investing Legend turns apocalyptic. Bursting of this great epic bubble will be most important investing event of your lives. The long bull market since 2009 has finally matured into a fully fledged epic bubble, featuring extreme overvaluation, explosive price increases, frenzied issuance, and hysterically speculative investor behavior. I believe this event will be recorded as one of the great bubbles of financial history, right along with the South Sea Bubble, 1929 and 2000. So this is Jeremy Grantham. The one reality that you can never change is that a higher priced asset will produce a lower return than a lower priced asset. You can't have your cake and eat it. You can enjoy it now, or you can enjoy it steadily in the distant future, but not both. And the price we pay for having this market go higher and higher is a lower 10-year return from the peak. And that's what I argue. Buying at the peak right now of the market means that over the next 10 years, you are going to have a lower and lower and lower return. And that's just it's basic mathematics, really. When you buy something cheap, your longer term return over a longer period of time is going to be much, much higher when you buy at the peak or buy something that's expensive. So now what does so Grantham, he says it's going to be a massive deflationary bust, that the market is going to collapse, and he's comparing it to 1929, and he may be right. He may be right if some of these things play out. Now, I'm not going to read this is his article. He wrote this in, I think, GMO. But what I do want to get down to is the bottom part here. So he compares it to, and look, he does have a good track record. He pulled out just before Japan in 1987, and I think it was 97 or 98, just before the tech bubble. And then he also was warning about the housing bubble as well in 2006, I think. So he does have a good track record. But here, so what to do? So he says, as often happens at bubbly peaks like 29, 2000, Nifty 50 of 1972, a second tier bubble in the company of champions, today's market features extreme disparities in value by asset class, sector, and company. Those at the very cheap end include traditional value stocks all over the world relative to growth stocks. Value stocks have had their worst ever relative decade ending December 2019, followed by the worst ever year in 2020, with spreads between growth and value performance averaging between 20 and 30% for the single year. Similarly, emerging market equities are at one of their three more or less co-equal relatively lows against the US in the last 50 years. Not surprisingly, we believe it is an overlap of these two ideas, value and emerging, that your relative bets should go, along with the greatest avoidance of US growth stocks. that your career and business risk will allow. And I tend to agree with that as well. So those of you who have been following my videos will know that I am predominantly a value investor. I like buying things that are cheap, beaten down, out of favor, that no one's looking at. And I've definitely been buying commodities for about 18 months now, and they've been super, super cheap. And some commodities, like oil from its bottom, has run up into its 50s. Copper has had a big run. Gold and silver has had a big run. And I've done very, very well. And I do have other assets that are very, very cheap. And I've shared how I've bought some stocks at under 2 times earnings, which is incredible. And I guess you could think of it as the Warren Buffett cigar butt strategy, but whatever. I like buying things that are cheap because they pay well. They pay well, and I'm happy to hold longer term. But in the last 12 months, 18 months, I've had wonderful returns, and you can go have a look at my video on my investment thesis and have a look at my 2020 annual results. Pretty outstanding there. But one of the portfolios that people are talking about is having this barbell or dumbbell portfolio, which is cash on the one hand, so not bonds, but cash to take advantage of any market crash. And on the other hand, having real hard assets, so your gold, silver, other commodities, so that you play that inflation trade on one hand, but you've got the deflation trade on the other hand. And I'm certainly similar to that when I think about it. My portfolio is quite similar to that. However, I'm happy to own gold in particular for a deflationary period, because every deflation and market crash that I've looked at, and I've measured it measured gold as well. Yes, gold has fallen as well. However, sometimes when markets, so I'll go back to March last year, the market fell over 30% and gold fell about 12%. So gold still held its purchasing power versus stocks, for example. And so I was able to convert some of that gold into cheap stocks and so forth. Yes, cash won't go down at all. So you'll get 100% of your purchasing power there, where gold did fall a little bit. However, if you have that inflation trade, then cash gets destroyed. Cash gets destroyed. So for me, I'm happy to own gold. I've studied gold and how it's performed in all different markets, and I'm happy to hold that for an inflation hedge, but also a deflation hedge, because I'll still buy more other assets like stocks and real estate by holding gold, even when those things go down, and gold does go down as well. Gold just doesn't go down as much. So I still get some purchasing power there. But in the inflation trade, cash really gets destroyed. Cash is trash, as they say. So, but I do have cash, and I've actually got quite a lot of cash at the moment, and I don't really like holding this much cash. So anyway, guys, what do you guys think? Are we going to see the markets continuing to increase to even further highs? Are we going to see a market crash? Are we going to see that 70s type stagflation environment? And what asset classes are you guys investing in? Love to see your opinions in the comments below. Once again, if you like the content I put on this channel, please hit that like button. It really does help, apparently. I'm told it helps. So if you can click that like button, that'd be fantastic. And really, really appreciate that. And I'll see you again on another episode of Finance Uncut.